Hello guys, good day. Trust you're doing wonderful. So welcome back to the course. So today is an interesting one. We'll be looking at ICT trading concept. Yeah, so ICT is a short form for the inner circle trader. Yeah, so his real name is Michael Huddleston. Thanks to him for this wonderful strategy. So today we'll just be looking at this few concepts. ICT concept is a whole lot, but we'll just be looking at these few variables or elements in this concept, right? And I know that with this you can start trading, with this you can get good setups, with this you can model, good strategy from this. All right, so let's get to work, guys. All right, so first of all, we'll be looking at liquidity. Liquidity according to ICT. All right, so let me just explain a little insight into the ICT concept. All right, so the inner circle trader is a trader who narrows down the model of the smart money trading, right? The smart money are the big guys, the hedge fund, the banks, the institutions. So the smart money is concept of trading is a kind of strategy that tends to mimic the way these guys approach the market. You get the point? Yeah. So what do they watch out for? How do they take positions? How do they move price from one direction to the other? So this concept, this strategy is just measured on that. All right. So first of all, this ICT strategy, ICT um, noted that market price is always influenced by liquidity, right? So if a market is buying, it is assumed that okay, there is a liquidity it is heading to go and get, right? Yeah, so there is a liquidity it's heading to go and get. If the market is buying, there's a liquidity it's heading to go and get. So we can call this liquidity. So this stuff. So if the market is buying, okay, there is a buy side liquidity it is going to rate. And at the same time, if a market is selling, there's a sell side liquidity, obviously it is going to rate, right? Yeah. So look at some of these concepts. I'm calling rate now, and I've not explained rate. So we'll look at this. So this is what liquidity. All right, so ICT frames that market price will move from liquidity to liquidity. If market is buying, it is heading to liquidity, and after taking that liquidity, it will go for the next liquidity. After taking the next liquidity, to go for the opposite, and like that continuously. Market is selling, it is heading for liquidity. After taking that, it will rebalance to look for the opposite liquidity, and that is how the strategy is venture. And since strategy is focused on liquidity, so what is liquidity? You know, we need to ask ourselves, what is liquidity? So in the market, there are two things happening in the market. Either you are buying or you are selling, and this is it. Okay, let's use this position as an example. So now this is a position two, right? So if I'm entering the market here, okay, let me say this is 1:3 trade. So my goal is to exit here and to make 3%, and my stop loss is this point, which is 65 pips. So I'm entering here expecting the market should ride up. So I'm entering here. What am I adding to this market? I'm adding liquidity to this market, right? I'm adding liquidity to this market because I'm participating as an active buyer or seller. So we can liken liquidity to the active participant in a market. Why at the same time volume and liquidity can be synonymous. Volume is the amount of transactions I'm willing to enter a market with, while liquidity is me actively participating in the market. Hope you get the point, right? Right. So as it is a market to move from liquidity to liquidity. So like this, my stop loss is a liquidity point, right? My entry is a liquidity, right? Because my money is at stake and price can move to that point. So since the market is a reaction between buyers and sellers, if the buyers are stronger in a particular market, the market will tend to move up. It is then that the demand is there is high demand of that particular asset, and at the same time is the seller's power is more, selling activity is more, the currency will tend to decline, right? Yeah, so that is a normal concept of the market. So, and each point, traders forms different kind of patterns in the market depending on their activity, depending on their relationship with the market, right? All right, so it's on this note that we'll be looking at the different types of liquidity according to ICT. So there are still more like equal highs, previous days highs and lows, but like I said, we'll just be narrowing our this session today by this concept. Yeah. So first we'll be looking at liquidity. So like I've just explained the concept of liquidity now. So there are different liquidities according to ICT we can make reference to in the market. Which first we have the swing high and the swing low. So let's look at the swing high and the swing low. What does the swing high and the swing low? How is the structure? How is it? How is the structure and what does it implies in the market, right? All right. So a swing high is a three candlestick pattern. So I can use this now. The swing high is a three candlestick pattern where the candle in the middle, so you see three candlestick pattern, this candle one, candle two, candle three, and where the candle in the middle, or we can say candle two wick or body is higher than candle one and candle three. Hope you get the point. So a three candlestick pattern where candle two is higher, the wick or the body is higher than candle one and candle three. So this is the swing high. At the same time, swing low is the reverse of this, right? Yeah, so it's a three candlestick pattern where candle two wick or body is lower than candle one and candle three. You get the point? Yeah, so what does it mean now? So this is a point of reference. This is liquidity, this is liquidity. So just stay with me, I'll be explaining something right away. So this is liquidity, this is liquidity. A swing high is a liquidity, this is liquidity, a swing low, this is liquidity. All right. So a swing high is a peak, where price reverses downward, and a swing low is a trough where price tends reversing upwards. So we can say a swing high indicates a bearish bias. You get the point? So swing high indicates a bearish bias, and at the same time swing low indicates a bullish bias. All right, so let me just quickly talk on something. So that's what we call confluence in the market. A confluence is a reason for you to enter a trade, and at much you need to have multiple confluences for you to partake in any given trade. So you can have maybe your trading plan, four confluences, checklist your trading plan, and then you can you can take your trade. You get the point? So maybe now you can use this as one of the confluence that, okay, if you want to buy a market, you want to see a swing low first of all being formed, and then you wait for other confirmations, right? Yeah, so note that there's another update. So a swing low is a groove where price reversing upward. A swing low indicates a bullish bias, swing low indicates a bearish bias. All right. So let's look at this now in the chart. Let's look at some swing highs. So for the purpose of this, we'll be using the 1 hour time frame, right? Yes, we'll be using the 1 hour time frame. All right. So if you look at this chart, I already marked this out. So you see different structure. Like I said, this is just the reaction of buyers and sellers activities in this particular asset. So now you see, what is this? What is this now? This is a three candlestick pattern, right? 1, 2, 3. A three candlestick pattern. So we can call this what? A swing high, right? And what do we get after here? Market sold. This is what? Swing high, right? 1, 2, 3. What happened? Market sold. This is what? 1, 2, 3. Swing high, right? Market sold. So please take note of it. See, at least you should just get the point. The candle 2 wick or the body is higher than the candle 1 and candle 3. So now you can see candle 1, candle 2, candle 3, candle 1, candle 2 wick or body is higher than this. So this is a swing high, a swing high. This is also a swing high. This is swing high. You can see, yes, this is also a swing high. This is swing high. This is swing high. This is swing high. You get the point? Yes. So these are swing highs. Swing high. Swing high. Yes. Swing high. Yes. So take note of that. And as well, swing low. So you can see three candlestick pattern, one, two, three. This low, this candle two is lower, swing low. So you see one, two, three candlestick pattern. This candle two is what is lower, swing low. So swing low, swing low, swing low. See swing low, see swing low. So what did you see now? We say a swing high indicates a bearish buyer. So when you see swing high, you know that market maybe want to sell, is about to sell as part of your confidence. I not say anytime you see a swing high, you should go and sell a market. No. Or anytime you see a swing low, you should go and buy a market. No, please take note of that. So here, what do we see get after here? Market sold. So now swing low, what do we get after here? Market bought. Swing low, market bought. Swing low, market bought. Swing low, market bought. You see swing low, market bought, right? All right. So this, you can see that this, according to ICT, you see indicate a bullish bias and a bearish bias. All right. So the next liquidity you can make reference to in the market is called the fair value gaps. The fair value gaps. So what is a fair value gap? A fair value gap is a three candlestick pattern. Okay, so let me just explain it overall. A fair value gap is an imbalance in the market. It's an imbalance in the market. So where we we have we have two types of fair value gaps. Yeah, we have two types of fair value gaps. So yeah, so fair value gaps. We have two types of fair value gaps. We have the CB and the BC. The CB and the BC. So fair value gap, like I said, is an imbalance in the market. So the CB is the sell side imbalance, the buy side inefficiency. So this is an abbreviation for the buy side imbalance, sell side inefficiency. So you see CB, BC. CB is for, you can say sell, you can say BC is buy. All right, so a CB is what? It's a three candlestick pattern where the wick of candle 1 and candle 3 does not overlap each other. Right, so looking at this now, we can call this candle 1, candle 2, candle 3. So now what of the week? See, this is a week, this is a week. So you can see that they do not overlap each other. So this is what I mean by overlap. Maybe this week now is longer, maybe to this point. So you see, to this point. So what do you get now? You see they are overlapping each other. So there is no fair value gap. This range is not imbalance, right? Yes, so that is just the point there. Right. So this is a fair value gap. So which fair value gap is it? This is CB. Why? Because you see the market was going down. Sell side is imbalanced because why? Buy side is inefficient to fill this. Sell side imbalance, buy side inefficient. So as well, this is a CB. As well, a BC is the inverse of this now, right? So this is what now? This is a BC, a three candlestick pattern, 1, 2, 3, where the wick of candle 1 and candle 3 does not overlap each other. Hope you get the point now, right? All right. So let's check this out now in our chart and see how we can relate to this. All right. So Alright, so fair value gap. So you can see this is a three candlestick pattern, 1, 2, 3, and you can see this imbalance. So this is what now? There is liquidity in this point. What this means is that in the future, price will come and read through this area because there's liquidity in this point. There's imbalance, right? Yeah. So fair value gaps. Okay, you can see this is a fair value gap. So you see that this one held price because as they say, price will move from liquidity to liquidity. So let's assume price came up to this other block. Rate, okay, you can rate this liquidity. So he came back, he retest this, if he rate this fair value gap, and then he head back upward. So you see this is a fair value gap. 1, 2, 3, they are weak, their body does not overlap each other. Fair value gap. So what again? So you can see this a fair value gap, you can see fair value gap, three candlestick pattern. So we have BC and CB. So this one is what? CB, sell side is imbalanced because buy side is inefficient. Here is BC, buy side is imbalanced because sell side is inefficient to fill this. So just take note of this. I'm not talking about entry models now. I'm just talking about the different liquidities you can make reference to in the market. So swing high, swing lows, fair value gaps. So the next one is imbalances. The next one is imbalances. So we have the other types of imbalance. Fair value gap is also an imbalance, but Yeah, but we have other types of imbalances in the market. So first we have what we call the volume imbalance, and then we have the gap imbalance, right? Yeah, right. So the volume imbalance is a two candlestick pattern where the wick of candle one and candle two overlaps each other. So you can see this now. So if I remove this, what do you see? See that candle one wick and candle two wick, they overlap each other. So I can come here and use my rectangle tool and mark this as volume imbalance, right? Because you can see the wick overlaps each other. So this is a volume imbalance. We'll also check this in the chart. And then the last one is gap imbalance. So what is gap imbalance? Gap imbalance is we can call it market gap at some point. We can call it market gap. It okay, this happens mostly during weekends. The market close on Friday, right, and opens on Sunday. So the market has closed. What if there are some activities that maybe that tend to appreciate price maybe over the weekend or depreciate a particular asset over the weekend? So the market is closed then. So we have that this okay, let's just this candle, this was where the last price closed on Friday, and then boom, on Monday morning, you know you are seeing price here. What does it indicate? It indicate that okay, that this asset, it gained some a little value over the weekend, right? So you see that this is Friday market close to Monday market open. You get the point? So this is gap imbalance. So this is liquidity, right? It's liquidity, yes. So what do you see? Market came, this liquidity, read it, and then it's pulling up. So this is liquidity. You can make reference to this point in the market. As it say, market to move from liquidity to liquidity. Market came to this liquidity, rated it, it is moving to the next liquidity. All right. So the last one is what we call the order blocks. Order blocks are powerful. Order blocks are powerful. When you start executing your orders in the market, you look at order blocks. So the last one is order blocks. So what is order block? Order block is a is okay, let me just explain it a little bit, not technically. I can just say is the last candle before the impulse move. It's the last candle before a breakout from a trend. So now if you look at this trade, okay, if you look at this chart, okay, if you look at this chart, you will see that there are some places that there were impulse volume was pumping to the market. Okay, like now, look at this now. See, market. Okay, this is an example of a volume imbalance. You can see the week they are imbalance. So market came through it and gain momentum back up. So an order block is a zone that, okay, let me say, is a zone that market has accumulated over time and then finally broke out from. When market is retesting this zone back, this is another block. It is a zone that okay, the institutional players, they were interested in pushing this price down to this point, right? So them pushing this price to this point, they will try to protect this area. Why? Because it's an order block and it's a good discounted point to buy price from. So this is a kind of bearish order block. When you see this consolidation is then a breakout, then we know that when price trade into this in the future, there should be a large move down. This is like order block. So the same for bullish order block. So example of order block is this consolidation before this impulse movement. When market trade into this to gain momentum back up, right? Yeah. So you can say okay, like this now. Okay, now make more sense. All right, so we can say okay, this consolidation, market broke out, came back, order block, and boom, it is pushing up. So this is an order block. This point, if market trade through this point, okay, you see it came to this point little bit and then boom, it dropped. So this is an order block. All right, so haven't covered the different liquidities according to ICT that we can make reference to in the market. So the concept states that market to move from liquidity to liquidity, that this market is mechanically run, right? Yeah. So we have finished the concept of liquidity now. So the next one, we'll look at rate. Rate. So what is rate? What is rate? So rate is a tap into a liquidity, right? So remember, like I was making reference to that gap imbalance, that market came and raided this imbalance and then move up. So remember, ICT say market will move from liquidity to liquidity. So market tapping into this gap imbalance now. It has raided this imbalance and then moving high. So now you see this is liquidity. Swing high, this is liquidity, right? So swing high, liquidity. What do you think happened here? This market came and raid this liquidity because this is a point of interest. There's there's liquidity, there's volume at this point. So market came to this point, raided it, and then it will head for the next liquidity. And where is the next liquidity? This can be the next liquidity, this can be pile ups of liquidity, swing lows and liquidity. Like we said, swing lows, liquidity. Market came right through all of that, you saw. So we call this raid, right? So swing high, e raid, this one was raided. All right, let me use a simpler example so that you get the point. So okay, so now you can see this now. This is liquidity swing low. What is this? This is another swing low. But what do you see happen? It came and raided this. So I sometimes we can call this raid in the market. Sometimes we can call this liquidity sweep. Sometimes liquidity grab. Sometimes a stop loss hunt. As the case may be. But this is raid. So market came raid this liquidity. What will happen? It will go for the next liquidity. So when we see a good order flow, so maybe like this order flow now, what do you see? You see that okay, market came down, this liquidity, it read this liquidity, this is fair value gap, it read this fair value gap. Where will it go? For the next liquidity, it read this liquidity, okay, this can be like an order block, it read this order block, it went down, you know then consolidation, it broke this structure. Then what again came to this point, you can see okay, read this liquidity to head for the next liquidity, this order block, tap on it, it broke structure, head for the next liquidity. Then you see this now, tap almost to this fair value gap, this is a fair value gap, you use this and boom, down, tap on this fair value gap, you will try to go down, you get the point. So market will just move from liquidity to liquidity, and mind you, we are just doing this in the 1 hour time frame. You can use the 4 hours, use the 15 minutes, 30 minutes, as the case may be, depending on the kind of trader you are, right? So that is the concept of raid. So the next one is the next concept we'll be looking, okay, the next variable we'll be looking under this concept is market structure. All right, so there's a video on market structure, so I will not dwell, I will not waste much time on market structure. I'll just simply explain it and then move forward. So market structure, we have the market structure is the flow of the direction of the market in a particular time. So we have three types of market structure. We have the bullish market, or we can call it the uptrend, or we can call it the bullish order flow, as the case may be. Then we have the bearish market, we can call it the downtrend or the bearish order flow. And then we have the consolidating market. So let me write this: bullish market, we have the bearish market, and we have the consolidating stroke ranging market. So we have the bullish, this bull, you can also call it slash uptrend, uptrend slash bullish order flow. Okay, sorry. Then you can also call this downtrend as well. Downtrend, or we call it bearish order flow. Right. So a bullish market is a market, is an uptrend, it's an uptrend when market is just moving up. So these are the characteristics you use to spot out a bullish market. It forms, you first of all start with a low. then form a higher low. Okay, form a higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. You get the point. So this is a bullish market. Consistently forming higher highs and higher lows. Yeah, right here. So a bearish market. So like this, you start with a high, lower low, higher, lower high, lower low, lower high, lower low. So this is the characteristic of a bullish market. Of a bearish market, this is the characteristic of a bullish market. And the other one is a consolidating market or ranging market. It's just a zigzag market with no clear direction. So at this point, it is an indecisive season of the market, right? So, but there's a video on market structure, so you check that out. Check it in the, you see it in the, you check up, you see it. So let's move over to the next concept in this strategy, right? All right. So the next is what we call the AMDX. AMDX. So what is the AMDX? The AMDX is a model by ICT depicting, how you can enter a position at a particular time. So, we can either buy, right? We can either buy or sell. And we buy in a bullish market or in an uptrend, right? And we sell in a downtrend. So in the uptrend, we wait for break of structure and then we are trying to buy. In a downtrend, we wait for break of structure to the downside and then we are trying to sell after a retracement, waiting for confirmations. Yeah. So what is AMD? AMD is an approach by the smart money. It's an approach by the smart money. They use it, to most times to drive price movement. Right. So this is the concept. A stands for accumulation. M stands for manipulation, D stands for distribution, then X stands for either continuation or reversal. You get the point? Alright, so it's like I have something here that, alright, so yes, I love this. So looking at this structure now, this is the AMDX. So first of all, as they said, market will first of all accumulate. It will first of all accumulate. Why is it accumulating? It is accumulating order, and this point is an indecisive point. You get the point? So at this point, you are not supposed to be trading. You are just supposed to be patient, waiting for breakout, right? Waiting for breakout, to either breakout to the down or breakout to the upside, right? But here is it. We have accumulation, manipulation, and distribution. So after this accumulation phase, according to ICT, said there is going to be a manipulation phase. So manipulation phase is a false move, and this is the concept. If price want to go up, it will first of all go down. If price want to go down, it will first of all go up. What is it going up to do? It's going up to take liquidity, then to fuel it to go down. If market want to go down, downtrend overall, it will first of all go up to take liquidity to fuel it to go down. If you want to go down, it will go up first, take liquidity to fuel it to go down. Alright, so this is the concept. First of all, market will accumulate. After accumulating, this will be a false move. According to Wyckoff's rule, he calls this the spring. We call this the springboard. This, it can be more of a kind of manipulation. So this is how you spot fake breakout. Number one, you spot fake breakout by checking for liquidity zones closer. So maybe you might have a market price, maybe past data, there might be a swing high here at this point. You get the point? So maybe the market just want to come and raid this swing high. You get the point? Market just want to come and raid this swing low, right? Before going up. Why? It's coming to, because there's liquidity here, right? As they say, market to move from liquidity to liquidity. So this market came, raid this swing low, and then before it will have a good momentum to drive price up, right? Because in the market there's supposed to be 50% buying and 50% selling, but most times the market is left in imbalanced state. So most times there are some orders that need, to be balanced. They need some, if some a kind of institution actually that want to buy a market, you need to engineer some kind of sales too, because its position is very large. So you need to fake some sellers so that you can buy from them, right? That is the concept. So after this accumulation, market will manipulate. This manipulation phase, you don't want to be finding this phase. So this is how you get it. First, after an accumulation, you wait for a manipulation, right? So you know you need patience. You wait for a manipulation, and then you wait for a distribution. Most times you can use key level to spot out if the end of a manipulation phase is, if market has really come to the end of the manipulation phase, because most time e can just continue the trend and the trend is just going, but then you need to wait and confirm. So this is another way to spot manipulation. Either you see wick, you just see a long wick, the wick will just go down, the candle will just go down, then you see rejection, 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 then maybe back to that zone, and there will not be break of structure. So that is what we call that, that is manipulation symptom. You can call it liquidity rate, stop loss hunt, liquidity grab, as the case may be. So this is the flow we want to catch. We want to catch the distribution, accumulation, manipulation, and distribution. So in the market, we want to catch the distribution. We wait to see manipulation, and then we catch the distribution. The last one is the X, the continuation or reversal. So after this, market might, if market want to continue to retrace a little bit, then continue the trend, right? Then if market want to reverse, it will maybe go into a consolidation state, indicating that there is no buyers pushing me forward. Then maybe if people now sense that okay, the market is, the buyers have lost control, or the buyers have no interest in the market, then they will now start maybe dumping the market. So from then you get a break of structure, and then this is what we call the reversal, or we can have the continuation, right? Yeah, so that is the AFDX. So it really works like in daily, in daily price. If you are a day trader, you can apply it. Most times it really works. All right, so let me just use the example. So 15 minutes. So today was, okay, this 31st March. So if you look at this, what happened? This was the Asia range. You see market just, okay, we can call this ranging. Market was just ranging, there was no clear direction, right? So what do you see? You saw that during the London Open, what do you see? You saw that market, what is this? This is weak. You saw the rejection. So this is what now? This is manipulation. Hope you get my point. This is manipulation. It went up, it did not break structure, manipulation. Then what happened? It now broke structure here. And then it retraced back, and then boom, you can pick your trade back to this, okay, to any of these zones, like a kind of order block. So you can see, maybe if I have taken a kind of trade from here, I will take this my order block. So this last candle, my, just take it like this. Then 1:3, I'm okay with that. Okay, 1:3. So yeah, this was the trade. Breakout, activate your SL here, and then 1:3. Not minding the low, just target 1:3 according to my training plan. So you see this trade setup. This is what manipulation. So be mindful of this in the market. Yeah. So this is for the AMDX. So the next concept is what we call the Q zone. So as an ICT trader, ICT um ICT um ICT Q zone ICT Q zone is a kind of session, a kind of time in the market where volume is being detected. The market operates in cycles, and there are some different sessions that controls volume depending on the kind of asset you are trading. If you are trading an Asian pair, there will be volume in the Asian session, right? If you are trading a New York pair, there will be so much volume in the New York. If you are trading maybe like the GPP, there will be much volume again in the London session. So Q zone are these micro times, these micro sessions, right? Not the overall session, but like a session where the volume can be spotted in the market. So Q zone are mostly used by day traders, right? Yes, they are mostly used by day trader. If you are a swing trader, forget about Q zone. But if you are a day trader, you can pay attention to this now. So let's use the 15 minutes. So you can see Q zone from 30 minutes downwards, or let me say 45 minutes. You cannot see it in the hour time frame. No, you cannot see Q zone in the hour time frame. So you can see it from 45 minutes, anything minutes, you can see it on the minutes, but you cannot see it on the one on the 1 hour or 1 day time frame. So look at this now. What you notice that okay, there are different types of indicators that indicate ICTQ zone. So like for me, this is my ICTQ zone. If you want to set it, come to your indicators, right? Click on indicators. So in my favorite, I just have ICTQ zone, tradinator, reflex FX. So I just add this is what I'm using now. So you see this ICTQ zone tradinator. So this is it. So if I just okay, let me delete it, let me just add it. So let me show you one major setting you have to do. So if I tap on it now, it will be added automatically to my chart. So you can see, so that you can see this dark one. I don't need this dark one because it does not capture my interest, right? So showing Asian Q zone, show London Q zone, show New York Q zone, show London close Q zone, right? And then that dark one is show central bank dealer range. I don't want to see central bank dealer range. So you can see this is my Q zone. This is how I customize it. So what do we have? Asian range, London range, New York range. So I like framing my setup from the London Q zone, right? London Q zone, then to the New York Q zone. The New York Q zone, there's much volume, for New York pairs like Euro USD or anything correlated with US dollar, right? Because the US dollar is a New York pair. Yeah. So this is London Q zone. If you notice now, there are significant price reaction during the London Q zone and as well the New York Q zone. Here, majorly news events takes place during the New York Q zone. So most times you usually just have some spikes and tough ranging. But then, a day trader is one who might want to capitalize on trade from the London to the New York and to the London close. You understand? So this is micro time. So this is London Q zone, but now you see this London close Q zone. So these are micro time where you can spot good opportunities. So now you look at this, okay, look at New York, saw this move. So look at this Asian consolidate, look at London, there was this move. New York, you see this move. So as a day trader, you can look at this day, saw this move, this breakout, a retest, and then you saw this move, and then you saw this. So you saw this London, New York, so that there's much volume, London Q zone and New York Q zone. So what is this London Q zone? So you see this move from London, see New York. Yeah, so this is a major concept in ICT traders. For day traders, if you are not a day trader, then you might not find it very important. But if you are a day trader, it is very important. So the last concept is ICT entry models, right? Yeah, so ICT entry model. So let's add everything together. We will add liquidity, rate, market structure, AMDX, Q zone entry model. So entry model is the end product of adding all of this. So let me say as a day trader, okay, using today's trade setup. So now I told you that what did I need to wait here? Maybe after doing my top down overall analysis, okay, I know that okay, somehow I was expecting price to come down, get to come down to this point. So my trading system allows me to take trade of 1:3 risk to reward. So on this day, what happened? Asian range. I spotted out the Asian range. And so what do you think will be here in this Asian range? This is liquidity. The Asian range, engineer the liquidity. And then I saw a raid of that liquidity in the London Q zone. I'll only take trade on the London or the New York Q zone, depending on my system, right? So now I'm using London Q zone for my entries. So after I saw this, this is a good candle momentum, indicating giving me selling bias. But then I'll not enter the trade. What will I add? First confluence, right? So what is this now? First, AMD manipulation, right? Liquidity has been manipulated, right? So after this now, AMD, what are we waiting for? We are waiting for distribution, but for distribution to go on, we need to add other confluence. Remember, this is a swing high. Swing high indicates bearish bias. So now what will I do? I'll wait for break of structure. So this is the structure I can find. So what is this? Break of structure. So what am I waiting for? I'm waiting for a retest to take my 1:3 arrow. So I'm taking my retest at order block. So what is my order block? Like I said, the last candle before the impulse. So this is the last candle. So I'll mark this range and I can use a risk entry for this. So if I use risk entry from here, my stop loss will be with this structure, but I can still put it here. But as a day trader, or a kind of intraday, yeah, or intra-session, any how you want to call it. So I will just target 1:3, and then you see this is my trade. If I want to be greedy, or maybe I want to target more, I can target maybe this swing low. Okay, this is a 4.5 risk to reward, but then my system say I should take 1:3, right? So now you see this is a profitable trade this day. Red break of structure, entry at order block, and then this is an entry model, right? So we do the same for this other day. So what are we looking at this day? So it's just the same thing basically. So Asian range, what is Asian range? This is the Asian range. So what did I notice? I noticed what? A rate of liquidity. This is what? This is okay. Like I was saying, you see this reaction. What do you notice here? You notice that this, you will not call this rate, you maybe want to call this break of structure, right? But yes, you want to call this break of structure because this now was rated, right? And then boom, you call this break of structure. So you wait for retracement to buy. So if you have bought this trade at this point with your stops at this point, you see that market would have kicked you. So this is why you don't only use, you don't only use this market structure to take your trade. Rather, you do what we call top down analysis. So if you did top down analysis, you will look at this trend first. And this trend, it has been consolidating for a while, but on this day, I was expecting price to drop. So for price to drop, I was expecting a kind of raid, a kind of raid. Maybe I was expecting price to go higher, then maybe break structure, as the case may be. Then I can venture now and sell down. So on this day, I did not take this trade because the setup was not clear, right? So rather, this was a break of structure. If I wanted to take it, it was buy, but then my top down analysis say I should sell. So I'm looking for sales opportunities, not buy. You get the point. Unless I see this market structure shift, you can see I indicated it, market structure shift, then I can buy the trend. So you can see that for this. Yeah. All right. So let's say this day, what are we waiting for? We are waiting for manipulation, Asian range. We are just waiting for a form of manipulation, right? So maybe I can look at this, waiting for break of structure. So looking at this now, you see there's no break of structure. So this now was a kind of break of structure, right? This was a break of structure. So because of this break of structure on Thursday, what am I doing? I am trying to sell this market, and I will sell this market at a good, what is this now? A good order block. Yeah, so this was my order block. I took this trade, my SL was here, and then my TP was 1:3. Yeah, I took this trade. So on this day we had a loss because it activated us. We were in profit, but we held on to the trade, and then boom, we had a loss. But then you see, if I stick to this plan, 1:3 risk to reward, yeah, I can lose this 1%, but the one that hit TP, we got 2% extra. So you can see we'll still be 2% profit in our trading account, right? So this is the system. This is ICT system. Okay, this day you saw red. So this was a red. Yeah, this was a red. Then what do we wait for? Break of structure. Break of structure. See, structure was broken. This one was broken. Wait for retest, SL, and then TP 1:3. You can see it. So this one now give us one. It gave us 1:2, right? So this one was break even. See, there was no risk on this. So you see, guys, this is the entry model. So let me just draw a schematic diagram of the entry model. So first a we have a structure like this. We have breakout. So when you see a breakout like this, what are you waiting for? or what do you want to see next? You want to get a retracement and a confirmation. So this is what now? This is retracement, right? This is retracement. So you don't want to just buy on this retracement, but you want to see confirmation telling you that market want to buy, right? So you now buy the trade. This is first way of trading. So the market break structure, most times it will leave an imbalance and other blocks, so you can use that for your entry as your zones for your entry, right? So this is one of the trade setups. As well, this is another trade setup. This is another trade setup. So market has been buying, market has been buying. So this one we call it a reversal, right? So see this, then you now see something like this. So after seeing this, this is what market structure shift. You wait for market to retrace and you are picking it down, right, to any of these zone multiple targets, picking it down. You can use trailing stop, right? So these are the different setups you can frame using ICT. So with this, I hope you find value. So I want to give you an assignment. Promise me that you do the assignment. So this is assignment. It goes like this. So let me say start from the beginning of this month. So start from the beginning of March. So you can see March using the 15 minutes. Apply this ICT concept starting from the London Q zone and look for setup trying to catch 1:3. Alright, let me show you what I mean by that. So let me show you what I mean. Alright, so this is March 3. So first, what am I seeing? If I wake up this day, this is my point of interest. This is when I will start looking at my market form. So I want to see a kind of raid, a kind of manipulation, right? So looking at this imbalance is something for me to watch out for, right? Looking at this imbalance, I want to see price feel this, because if price feel this, it is reading it, then maybe I want to catch opportunity up, right? Right. So seeing this market tap into this, right, it makes sense to me. So this is what? This is rate manipulation. So what did I want to say again? Break of structure. So I'm looking for break of structure. So this is what? This is structure. This is what? This is structure. So this is structure. This was broken with this good momentum. It captures my interest. So I want to buy this market. What will I do? I'll buy it from here at this retest of this key level. Take note. Then my asset will be at this point. But as a day trader, if this is my approach, this one now I'm not using order block. So pay attention. I say backtest this now. So I'll use this. I'll put this at this point. 14 pips SLC at this point, at this imbalance range. Then I'll now do what? I'll target 1:3. This target is not, why I'm targeting this, because this is imbalance. Why? Price will read through this, because this is fair value gap, is a liquidity. So I can target this or target this swing high, right? Or target maybe this other block, but then 1:3 is what I'm targeting. So this is my trade. So what happened? Market activated me after this breakout, and then boom, TP. Monday 3rd of March, right? Monday 3rd of March, we got this. So we'll do the same for Tuesday as well. So Tuesday, sorry, the network is giving me issues. Okay, doing the same for Tuesday. So this is Tuesday. What are we waiting for? We're waiting for some form of manipulation, if any, and then maybe with our overall top-down analysis, we're trying to join the flow. So looking at this Asian, London, I can see some pile up of momentum. Market is buying with this momentum now, and I am bullish in this market, buying this market. So if market is just break out, I'll likely join the market. So now I'll plot these highs. Okay, this high. So by 8 o'clock, I'm looking at this market. So this, I'll plot this high. So now plot this again. Plot this. Okay, just plot this. To plot this. So what am I doing now? I'm using my limit order. I've seen this breakout. Use my limit order. Buy my market from there. Then my stop loss at this low. Okay, 14 pips. Yeah, so at this, then 1:3. 1:3. So what happened? Market came back, activated me, TP straight, bam. Then and I was off from here. So Monday, Tuesday, see it's the same system we are applying. So on Wednesday, what are we doing on Wednesday? Wednesday, okay, market is bullish. Yes, we're bullish. So when you see this now, you see that okay, this was a resistance. Market tried to sell. So from here, I wanted to get sell reaction. So I not see sell. So I now saw this candle form. So 8 o'clock, this is when my focus is on the chart, and I saw this rejection. So for me now, I'm expecting the market will start selling from here. You get the point? So that's just a kind of market insight. So but what happened after here? Instead, market broke structure, because this is not a break of structure, rather this is. So I'll mark this now. So you see, I've marked this as a break of structure. So what will I do? My limit order, buy limit at this point, my SL at this low, my SL at this low, 14 pips. Yeah, so what happened now? 1 is to 3. So what happened to this trade? You see, we never get tapped. We never get tapped, we never get an activation. So this day, no trade. But we have made 6% already, or 3 arrow, depending on what you're risking. So this day was a Thursday. So what are we waiting for this day? So like this, maybe, okay, we just want to get a breakout, a kind of manipulation and a breakout. So how we position? So we're looking at this range, Asian range. Asian range was rated here. So this was a low. We marked this low. We marked this low for breakout, right? So what happened? Market came right through this point. This was not a breakout. I don't call this kind of candle breakout. No. So it came. There was no breakout. Okay, let me draw this now so that you see. See, there was no breakout. I don't call this candle breakout. So I'm out of my London Q zone. So I cannot take trade yet. Then maybe I want to take trade. I'll look at this. So looking at this now, what did I see? I saw that okay, market broke structure within this, but then I'll take trade in my New York. So what after breaking structure here? So this is my New York. This is my New York. So if I see this candle, you know, okay, this was a new, so I will not trade this because I will not enter impulsive. So maybe no trade for this day. Thursday, no trade, but there was a breakout. If I wanted taking that trade, I'd have taken it outside Q zone. Then my SL 14 pips. You get the point. So market came, I was not kicked, and then let me see, 1 is to 3. You see, it was a good day because after this breakout, market came down and then hit our TP before crashing. So, but I would have not taken this trade Thursday. So Friday, let's see on Friday what happened. Market came. Okay, this was where we got a breakout. So I can mark this right then. Use my limit order, buy limit, my SL at this low, yeah, 14. Then targeting what? 1 is to 3. Alright, so market activated us here, went up, boom, TP hit. So wow, this day was very profitable, exception of there was no SL, exception of this day where we missed this trade. So in total, 3 arrow times 4, that is 12 arrow, made 12 arrow for the week, right? It was profitable. All right, so we have built a system we can work with. So go ahead and backtest this. So I stopped at Friday. So whenever you see this, start from the beginning of the month. You understand? That month that is currently running starts from the beginning of that month, or you backtest like 2 months of data. You understand? To have an edge, you can deploy the system as well. So with this, thank you very much. Hope you found value in this. As you come to the end of this session, do well to check the next video for insightful updates. Thank you very much. Do well to hit the like button and the subscribe button.